Good evening, everybody. This is the second session after the inaugural run which we had recently in the last Saturday. This is a very interesting topic which is required for all of us. So, last session we had almost 2 hours of inputs. To start with, wealth management means a lot for different kind of people have a different kind of perceptions what the meaning of wealth is and how to manage it. And to start with, we have started with this slide. Now we started with this slide. I think, is it audible to everybody? Am I audible? Yeah. Okay. So whether we are poor, middle class, or rich is a matter of something called as a choice. And we have to make a choice whether we want to be poor or middle class or rich, depending on our spending habits or the way we manage our finances. Then the second one is, this is the normal financial management with which most of us do. All of us fall into either of these categories. Normal people, the so-called middle class, who don't accumulate wealth, they're all people who tightly manage their finances in such a way they don't left out with any surpluses. So they have zero surplus. Whereas there are few people who don't have any financial control, so they land up in debt. Then the third category of people, they are the people who are more disciplined, so they have some savings. And the fourth kind of people who decide what the amount they have to save, and then accordingly they conduct their expenditure. So these are the fourth category of people. And the fifth are those people who decide how much they have to invest from the income sources which they get. And these are the people who are very smart, and they tend to become more richer. So we, as a category people, we have to we so sorry for disturbance. Yeah. So we, though we may be at any of these four or five categories, we can always make a smart decision to become a smart and intelligent investor where we can become wealthy. So making wealth or becoming wealthy is a matter of choice. And for that choice, we need to have either of these, kind of a management with our incomes. Everything boils down to income. So the next, what we see here is the wealth pyramid of India as a whole. So if you see, only 760 individuals in the entire country who have wealth of more than 100 million, whereas 1060 people are having wealth between 50 million to 100 million. Whereas 2.4 lakh people have wealth between 1 million to 50 million. These are all in US dollars. If you see the bottommost thing, that is around 92.3 percentage of Indian population. It's only adult population. They have hardly wealth less than $10,000. That is not more than 8.4 lakh rupees. So this is where, the as I said in the past, it all depends on the habits, the kind of habit we make. And then this is one of the very important life cycle of any kind of a thing. It's basically an innovation thing. Like whenever a new innovation comes, the innovators who are, they have given some percentage people, like around 2.5% of population, are generally innovators. They are a separate class. They they don't like the routine or something which is already existing. So what they do is, they tend to innovate, they come up with new solutions. And those solutions may be an idea, it may be a new technology, it may be a new process, it may be a new way of doing business, it may be a kind of a totally a different business plan. which may give them an edge. So those innovators, along with somebody who are smart investors, they may be angel investors, it can be your own friends, relatives, it can be some private equity, the so-called PE funders, then venture capitalists. So these two segment, they put money into it and finally ensure that the product comes to light. And not necessary that every product or every idea or every innovation will ultimately lead to adoption by the entire of the society. So there is something called as a chas. The chas means a situation where this particular innovation or technology or invention is going to be adopted by world at large. When majority of the public adopts it, then it becomes a very successful product. And this is where, see, your management of your wealth or incomes or your investment depend on identifying such kind of rare opportunities. Why? See, as per SEBI study, around 90 to 95 percentage of the people land up losing money in the stock markets, and especially those people who are into either option and that so-called derivatives trading, or or else the second category is short-term traders. And short-term trading is not everybody's teacup, especially not for people like us, because we are very busy with our professional life. So we don't have that flexibility which professional traders tend to do. So let us not mimic it unless we are totally into it. And this particular scheme of things, like the innovation, the stages which I have seen, I have shown in this particular graph. There is a very interesting theory called as computers theory of capitalism. He says that the innovators bring with them something called as a creative destruction. They destroy everything which is old order, whereas they create new things. It can be a new technology, it can be a new product, it can be anything. So these creative destruction will lead to totally, generating a new kind of a skill set, new jobs, new kind of, people who are into it. And those people who are wedded to the past, they either have to adopt to them. They have only two options: either beat them or to join them. And if they don't follow either of these two, and they definitely land up into trouble. So this computer, what he says is, because of this creative destruction, old order will be replaced with a new order. So the new order that leads to, generating a lot of wealth, and these innovators in the process, they tend to get, funding from the so-called funders, the early funders, and they are the ones who takes this particular uh, product into the life, and it has a life cycle. And that product life cycle, like any every other organism, living cells, it has a organic, there is a birth, then there is something called as growth stage, then maturity, and finally decline or death. So everything, every product has to go through that, including technologies. There are certain things which may sustain for a very long run, like FMCG, like fast moving consumer goods, or our food, beverages. These are the things they are going to survive for the entire of the entire, till the human race exists. So whereas certain technologies, say like radios, for example, in the past, like they got eliminated once the moment they the TVs have come into existence. And then later TV with they found competition with so-called computers. But however, the old generation TV sets, like say CRT TVs, like you say, you name Onida or Western, Optron, all those kind of companies, they're all totally vanished. Whereas three companies which survived are Sony, LG, and Samsung. They survived only because they have reinvented something called LCD, then LED, then OLED, QLED. So they are they are bringing innovative products whereby the product life cycle of that or the industry life cycle has got increased. So this keeps on happening, and unless we understand this particular thing, we cannot take exact call into any kind of a what do you call uh, uh, industry or any company where we have to invest in. So the next one is there are certain factors which determine the entire how a market runs. Basically, it is demand and supply. The rest of the indicators are they are all what do you call enabling factors? Maybe market indicators, confidence level, war, and other conflicts, or even concerns over inflation, government fiscal and monetary policy, technology changes, etc. Then we discussed about last time we discussed something about the villain, and this is nothing but inflation. Inflation is one thing which you know reduces the value of your wealth. So you have to fight this so-called villain or the so-called inflation. And in this last time we have discussed who is the hero. Hero is you. You are the one who are fighting the villain and trying to grow your wealth. So the agenda last time was like religiosity versus wealth. Then the rich people, richest billionaires in the world, and India. And then I have given a case study of Jews. So then today we will be having a little bit. In any case, we have discussed about the product and then the diffusion of innovations, all that stuff, and computer theory a little bit of. And then we will have something called as typical strategies and mistakes of high network individuals in India commit. So this is the topic for today. And then later we will switch over to diamonds in the dust, coffee can portfolio, mutual funds, traps to avoid, and how to construct a portfolio. So about me, I belong to 2000 batch IRAS from Civil Services exam 1999, and now I am posted as FNCO Construction, a native of Vizag, and I did my graduation from Andhra University initially. Then I joined the service. Later, I did ICWA as Company Secretary, LLB, MA History, MA Psychology, MA Economics, MA Development Studies, MBA Finance, PG Diploma in Urban Planning and Development, several MOOCs from Harvard and MIT, University of London, Sustainable Development Academy, and finally in 2023, I did a course called as Chief Financial Officer course from IIM Calcutta. So the positions I held in the past is as AFA, then EDP manager, Deputy FNCO. Then I was divisional in charge of two, accounts department of two divisions. One is Voltaire division, that is Visakhapatnam, and then the other is Sambalpur. Then later I had a stint in Railway Board as a Director of Finance. Then I was a Director in Ministry of Finance, DIPAM. DIPAM is Department of Investment and Public Asset Management. Previously it used to be known as Department of Disinvestment. And currently I'm FNCO. So last time we had a kind of a definition related to wealth. What the wealth mean? Wealth means many things to many people, but usually it is anything in abundance. It can be a possession or money. Then wealth management is a kind of advisory services that combines other services to address the need of affluent clients, and they are supported by somebody called as wealth management advisors. However, since most of us do not have 50 lakh, which is mandatory minimum amount to take this so-called project management services, sorry, portfolio management services, so we will be left out to manage our own wealth. So literally we are our own wealth managers. Then why wealth? There are, it's like everybody needs money to fulfill their basic needs, the comforts, creature comforts, maybe owning a house or education needs or your own security needs within the home, or even food, beverage, your social needs, all that stuff. will be taken care of by the wealth. And in any case, wealth ownership is highly concentrated, and if you are wealthy, naturally, you will it'll lead to increase in the political influence, and also you will get a better opportunities, be it economic, otherwise. So again, there is a very you can say inverse relationship between religion and wealth. What is religion? Religion is basically a belief in the worship of human, superhuman controlling, power, which we call it as a god. So it's all about the belief systems and worship patterns, and it is different in different religions. So religiosity is a strong feelings of being religious. And also last time we have discussed about internals and externals. Internals are those people who believe in themselves. Externals are those people who believe in external factors like God or fate. And those are the people who cannot make their choices in the way it has to be. Unless you tend to believe in yourself, then the management of the wealth and all that stuff would become a bit different. So you have to make a very conscious choice whether you want to be a believer, a staunch believer, or you want to be pursue something called as your wealth. Then there was a scatter plot, which is some I got it from the internet. So in this, if you plot on the x-axis the so-called PPP purchasing power parity in US dollars, annual purchase, per capita income, and then on the y-axis, if you see the religiosity, you can fit in all the poor countries of Africa, Asia, Latin America on the on the top left side, which indicates that those they are very highly religious, yet they are very poor. Whereas if you see go towards lower quadrant or to your right, you find those countries which are rich, they are less religious. So there is a negative correlation between the wealth and the religiosity. Then we had a case study related to, in detail, we have discussed about Lisa Kester of Ohio State University, who has propounded a thesis called as Religion and Wealth, the role of religious affiliation and participation in early adult asset accumulation. It's a very interesting case study in which we have discussed how the religion influences your wealth and why Jews happen to be more successful when it comes to accumulation of wealth. So that was the topic for last time. I do not want to repeat it so that we can go ahead with the next set. So this, I think you can go through the previous video, and there is very interesting study conducted by CNBC in 2015, where they have identified the religious affiliation of the 1 million plus rich people. So they come up with a very interesting thing, like Christians, who constitute 31 percentage of population, they constitute somewhere around 56.2 percentage, whereas Muslims 24.9 percentage population, global population, and they have somewhere around 6.5 percentage representation, whereas Hindus with 15.2 percentage population, it is 3.9 percentage. Jews just 0.2 percentage population, whereas their representation is 1.7 percentage. And unaffiliated and others, which are usually other religions like Buddhism, Jainism, Shinto, and all that stuff, or anything like even Chinese, who are unaffiliated to any of the religion, they constitute around 28.7% population, whereas the HNI population is around 31.7 percentage in this category. So I have put one richness index, like percentage population, sorry, percentage in high network, percentage high network individuals divided by percentage population. So I got a factor. That factor for Christians is 1.81, Muslims is 0.26, lowest is Hindus 0.256, then Jews 8.5, and unaffiliated 1.1. Whereas the percentage wealth each of these religious affiliations control is Christians control 55%, Muslims 5.6, Hindus 3.3, and Jews 1.1, and unaffiliated 34.8 percentage. Similarly, I have put this wealth index whereby again the best is again Jews, the worst is Hindus. So what does this give is like, this is what the factual position. And then it's not that all these people are homogeneous. There is a lot of heterogeneity, and also it's highly skewed. So next, if you go to the social composition of 100 rich in India, like we find in the entire North India, Baniya, Vanik, Maheshwari, Sindhi, Khatri, and Jain, and even Muslims. Three Muslims who are North Indian Muslims, three are South Indian Muslims. They are Mapla Muslims, South Indians are. North Indian Muslims, they have again a lineage of either Jew or Parsi or even Baniya converted Muslim. Then whereas Parsis, anyway, Parsi I'm not putting into North. They are basically people from Iran who got migrated and settled in Gujarat and predominantly in Bombay. So then when it comes to South, if you see the in South, Brahmins have 12, then Reddys 4, Nadar 2, then Kamma 1, Jat, and of course Lohana is basically a Rajput from Gujarat. Then Chettiar 1, Vellalar 2, Christians 3. All these three Christians are Kerala Syrian Orthodox Christians. Then there are two Patidas, one Lingayat and one Nayan. So this is the top 100 rich people in India. Then I think one I have neglected. I think that, okay, that slide is missing. I made a case study of the Jews. Yeah, it's coming at the later stage, right? Okay. Now, who owns the companies? See, India's wealth or any country's wealth is mostly with the companies, because companies are the ones who do the enterprise, and then what they do is they generate income, sources of income, where that incomes by utilizing the resources that lead to something called as a wealth. They create wealth. The wealth creators are the companies. Companies usually are owned by, why all the rich are from these industrialist background, is because they churn the wealth. So in India, the composition is 45.13 percentage is the private promoters, whoever promote that company. They own 45.13 percentage of the wealth. Then whereas foreign institutional investors, they constitute around 20 percentage. Whereas this mutual fund 7.75, and we may have a slice of it if you are an investor into it. Then being a retail investor, you will be your slice may be 7.42. So then comes his Indian government 5.48 percentage, insurers 4.99, LIC 3.83, others 3.16, and high net worth individuals is 2%. This is only a kind of giving you an information about who owns the companies. Then the rich side, like it is usually we tend to have a perception that only people staying in, say, metro cities only will grow wealthy. But whereas yes, in India there are so many people from countryside out of which 178 tycoons are found whose net worth exceeded 1000 crores from various cities in India. So predominantly you find one near Gujarat, Rajasthan, that is one area. Then the other area is Tamil Nadu and adjacent Kerala. These are the two areas which where you find a lot concentration of wealth. Whereas rest of India, there is a some spread, but not exactly concentrated. Then the case study of Jewish, we there was a basically, usually it is said that Jews became rich because they were prohibited to be a farmers, and then they were prohibited from owning a land in Middle Ages. They became money lenders, bankers, financiers, all this blah 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 kind of a thing, and they were dispersed, they were being tortured, butchered, all that stuff. which is basically kind of a historically incorrect and untenable, which is being proven to be incorrect by two professors. They are basically professors of economics. One is Italian professor Marstella Bozzini and Zvi Eckstein, who is a Jew from Israel. And they, for their work, which is around spread across 12 years, finally they got the highest order in that particular country, right? And the book they have published is The Chosen Few: How Education Shaped Jewish History. It is the history between 70 AD to 1492 AD. So, as per that particular book or the research, what they found is during Jewish Roman Jewish war, after a considerable amount of struggle between both the parties, or rather strife, finally Romans succeeded in destroying the Temple of Jerusalem, which was used by the Jews to raid against the Romans. So once that is destroyed, the power got shifted from the high priest, Jewish high priest at Jerusalem, to rabbis. Rabbis were, totally decentralized and scattered. They have imposed some code of conduct, like it is compulsory that the kids have to go to primary schools or synagogues. And during this particular education, they have imparted something called as financial discipline. And see, out of 100 percentage, they have said ki every person should uh, contribute 10% towards teeth is basically voluntary, or you can say tax in favor of religion. Then the second one is 10% towards charity, 20% towards investments, long-term investments, 10% for emergencies, and a rest 50% towards your regular expenses. So this made them very much, that so-called financial planning and management has become a kind of a hardwired into their gene. So once it is wired and they behave and they tend to follow the principles which are being taught since the early ages. So that led, the literature led them to shift from agriculture to other professions like money lending, finance, crafts, and trade. So during the Muslim Empire under Umayyads and Abbasids between 7th century to 13th century AD, these people have migrated to their capital called as Baghdad. So Baghdad gave them a lot of opportunities to accumulate wealth, and once from there they have migrated to other parts of this Abbasid and Umayyad empire, be it to Yemen, Syria, Egypt, Baghdad, Byzantine, and later into Byzantine Empire, Iberian Peninsula, the North Europe and Maghreb. Then this migration led to lot of economic opportunities, and they were naturally, because of their education, better financial discipline, and also having accumulated skills and finances. This accumulated capital helped them when there was a fall of Constantinople in 1453 to Ottoman Turks under Mahmud II. So after that, the land route from Europe to Asia was closed for trade, and that made the so-called Europe. Europe was totally dependent on spices, and spices from the Asia. So they were without spices, they could not eat their food. It was totally bland. So that led to certain adventurers to find out some sea route. Finally, initially it was Columbus going to India. He discovered America. That led to discovery of Americas, and Americas have gave them immense wealth, especially to the Spanish and Portuguese. And then that later led to the kind of excitement among other Europeans, be it Dutch, English, French, Germans, or other. other European kingdoms and European countries. So that led to it's like a gold rush. So these adventurers, they were stripped of money. They had to go for some the so-called uh, uh, funding from somebody, and it was the Jewish who identified the opportunity. They have funded these kind of wealth. Not only Jews, it was the Christians also, whosoever are rich, the neo so-called bourgeois class. They have they have helped these adventurers to accumulate to do that adventure, and finally that led to many discoveries, like sea route to India, then Southeast Asia, and then these people, these adventurers, they found that these countries are very poor. Then at the same time, they are poorly organized. So they brought in something called as mercantilism, later into colonialism. So initially for trade, later once they understood that the politicians and the political parties are pretty weak, or the kingdoms are too weak, then these people have invaded, and then later they controlled, almost colonized almost all the continents. So that is how this led to accumulation of wealth, and then this, along with two more events, like one is the age of Renaissance, like people who have because of the readings of the church, or whatever, or the influence of the church, they left out going into the classical literature. Then that gave rise to something called as age of reasoning, reason, logic, then science, all that have spawned out. And initially that was in conflict with the church. So many people whosoever has tried to come in, like your Galileo, Copernicus, whosoever, they have challenged whatever the teachings of the church. They were being blinded or put behind bars, and they were put to death. So, and later one event that has totally transformed Europe is something called as Reformation. Reformation within the church. And it started with the Martin Luther, who was from the clergy, a son of a clergy, who wanted reformation from within. And he met the Pope, and to his surprise, Pope was unwilling, and then finally it led to am I visible? Like, I think, hello. Yeah. So finally, that led to something called as a war between Protestant North and Catholic South. Catholic South under the Pope had led it. Finally, it led to the defeat of the Catholic South, and then the victory for the northern Protestant nations like England, Netherlands, Germany, Denmark, all these Scandinavian countries. And that led to opening of something called a series of innovations that led to industrial revolution. Once the industrial revolution set in, there were a lot of inventions, innovations which went on. So that was basically aided and abetted by the Jews. Jews funded them, and then that is how Jew became more rich, and they were totally benefited from all these stuff. And finally, if you see their contributions, 25 percentage of Nobel Prize winners are Jews because of this. And then now coming to the characteristics of rich, not only in India, elsewhere in the world, is that, yeah, actually why I'm bringing it is, yes, we need to, if you want to be rich, you need to understand what the rich, how do they think, and what do they do. Unless we know that, we cannot think of being rich. So what do they do is they emphasize on literature and education, and then they have a wonderful ability to adapt to the changes, be it changes in technology, society, or ideas or fashion. Many times they either bring those changes, or they fund those changes, or they associate with the people who make changes. And they always fund these people, and then they take the risk, they push it forward and ensure that those kind of ideas and the products or technologies is ripe, and they exploit that, and then they become more richer. Then the second thing is they have a diversity of skill base. Their skill sets are not just restricted to few things. They diversify it into almost all areas, through something called as a pursuit of excellence. They try to pursue excellence in the field or in the area where they are very strong in. So that pursuit of excellence leads them to go even further, better, and then that's where they find a niche out of particular areas, and then they deliver. And they come up with the brilliant ideas or a brilliant business plan, and finally they tend to exploit that and become more rich. And then most common trait among all these rich people, rich class, is they migrate. They are good at migration, and migration happens both at a richer level and also at the lower level. And always the migrant in any country, be it US, India, or anywhere, they are always better than the local natives, for the reason that the one, they will be always better because they have a better education, and they have better skill base. They have a better understanding of things. They understand psychology better, people, what works, what don't work, they understand it better. And then they also have brilliant ideas, so that they pursue it and ensure, and then finally they succeed to control, though they are in a microscopic uh, microscopic minuscule in that particular population. They tend to uh, you know uh, be more powerful, more richer, and they are also less religious, less superstitious, and then they take advantage of every opportunity they get. Then they have a better and superior organizational and networking skills. Another skill which I felt is like they have a better ability to learn new skills and technologies. They are crazy about learning. They want to every day they try to learn, and every day they try to implement something new, and they don't shy doing certain things, even if it may lead to say some losses or failures. They don't mind it, and they don't have something called as a fear of unknown, which most of us suffer from. We tend to fear, like, what will happen if I do this, if I am not successful, what next? I don't have any other alternative and option and opportunities. Then they generally lead, they don't follow. They are good leaders, and they have excellent leadership skills compared to others, and they tend to accumulate and grow wealth, and then they don't distribute the wealth. They distribute to the charity, but not to the extent that they distribute everything of them. Then they have something called as better polished language and etiquettes. So these are the common characteristics of rich people. Then last time, this is where we have stopped. Should we start again? It's now 9:15. Yeah. Chalo, this is the next part. That is asset classes, the millionaire club in the world, global millionaire club. Compared to, I'll put the next slide is about Indian millionaire club. What kind of asset class do they have? And we are making a comparison kind of. So they usually go for something called as private equity. They go into those companies which are privately held companies, or so-called in Indian parlance, it is private limited companies. And they also invest heavily into private debt. Then third is developed market bonds like US, Europe, Japan, Germany, and so on. And then the fourth one is private equity funds or fund of funds, right? PE funds, like they they just put into, they'll identify some unicorns or a startup, then they will put money into it. Then the fifth area is developed market equities, like equities in US, Europe, or Japan, or Australia. These are the countries where they invest into the so-called Fortune 500 or even other promising companies. Then the sixth area is they put into real estate. Then the seventh is they fund the infrastructure projects. Then the eighth is emerging market equities, like countries like India, China, Indonesia, Brazil, etc. Then the ninth asset class which they own is the cash and cash equivalents. Usually they don't put too much of cash with them. They usually invest into various asset classes. Then they do something called as hedge funds to ensure that the risk is mitigated in any of these asset classes. Then 11th is commodities. Then 12th is gold and precious metals. And 13th area is emerging market bonds. Like countries like India, whenever they come up with some corporate bonds or even government bonds. So this is the area where they will invest some amount. And then finally, art and antiques. This is where they put a lot of money into. So, whereas the wealth held by Indians in India is somewhere around 10.7 trillions, out of which 50% of our wealth we invest into property, be it real estate or house, and which is highly illiquid, and you tend to put all your savings, lifelong savings into it. Many a times you take a lot of loans, and then for the entire major chunk of your life or your profession, you tend to repay those loans. So these are a kind of an asset. It is easy to accumulate but difficult to dispose, and they are least liquid assets. Then the 15 percentage is into gold, though liquidity is not a major area, but it is not monetizable asset. You don't monetize gold unless you take some a gold loan or you sell off that particular gold. And then 15 percentage is in the form of bank deposits, where you get fixed rate of interest, usually 7.2 percentage rate of interest. Then there is something called as insurance funds, 6.2 percentage, and then PF and pension funds, around 5.7 percentage, whereas cash we hold around 3.5 percentage in the form of cash, and then very few, that is 4.8 percentage into equities. This is what is the difference between us and them. So what we tend to do is, our people tend to put into the illiquid kind of a assets, whereas those are physical assets, whereas they put into financial assets. And financial assets are highly liquid, and you can always convert, and especially for people, middle class people like us, working professionals, where we tend to be in a transferable job, it's always better to go for a financial assets than going for a physical or real estate assets. Even gold is not something, and in further slides you'll come to know about it. Probably may not be today, maybe in the next sessions you'll come to know each asset class, how much they are going to give you, what is the kind of returns. In the last 10 11 years, I made a study for last 11 years, and then I have just simply calculated what is the percentage growth each has given. So that those slides I will share at the later stage. And then then I'll show you typical. This is the financial planning. If you tend to go to a wealth manager, what they try to show you, and very surprisingly, this particular thing is missing something called as an equities. They never suggest you to put into equities, because if you put into equities, they don't get any commission. So what they suggest is you to put into liquid funds for your emergency, and for financial protection you have to go for life insurance or health insurance, liability insurance, then disability insurance. Then they always say you invest into asset classes called as short term. They always suggest you mutual funds, right? Like for a short term, it is liquid funds, ultra short term funds. Then for a medium term, they suggest you hybrid funds, ELSs, ETF. Then short and middle term bond funds. And for long term, they always say you to put into diversified equity funds, NPS, and sector thematic funds, right? And then there are a post retirement. They suggest you to put either PF, NPS, mutual funds, pension funds, or something which gives you annuity, returns, monthly or annual returns. They are usually annuity, rental income, systematic transfer. So this is what they typically suggest. Whereas what is missing is the part which you would like to be more interested into, that is equities. And equities is, though it gives you good amount of returns, but it has a lot of risks, and there are so many potential landmines where many people otherwise competent, and they all land up into trouble. And there are two case studies which is from a book called as this, what is that, Diamonds Under the Dust by Saurabh Mukherjee. So he gave a two case studies. This I made it into, see, initially I went to address people from my Andhra, so I have made it customized to AP. But yeah, it's a case study. There are two case studies in it. Case study number one is a person who is a CEO of company with a seven-digit salary. He is, he invested into two luxury apartments, and then he has given that money, but that was blocked because builder failed to complete due to demonetization. It's a case which is a which is during that demonetization era. And then later, whatever the asset, whatever the money he had, he either put into gold or a bank FD in a cooperative bank. And that cooperative bank, unfortunately, it also got crashed and went bankrupt. Why he went into FD of a cooperative bank? Because they are offering better or interest charges which are on a higher side. So out of lure or pure greed, he invested into highly risky cooperative bank, and finally it's totally bankrupt. Now his net assets are 9 crore, out of which 6 crore is into flats, 2 crore into gold, and 1 crore into FD. Whereas his requirements based on the social profile he has, socio-economic profile, so he need 20 crore over a period of decade. So how will he get this money? So one is the area where he has invested, especially real estate, totally crashed. And then gold is good asset, but it's only 2 crore. Where will he put? And the flat he owns, they are of say worth 6 crore rupees, and that too two luxury apartments. Then only 1 crore in FD is available with him. So how he has to manage it and multiply the wealth, because whatever liquid I could see is the gold part and the so-called FD, and he can even easily divest one of the apartment to liquidate it and put into kind of an asset, and he can plan it in a better way. So however, this is the usual case study, and then there is another guy who is from IM. He is a topper of IM. He is working in MNC in a very higher position, and then he also had similar 7-digit salary, and he owns, he wanted to own, or his dream is to own a villa at Goa, whereas he owns 2-bedroom flat not in Hyderabad. Actual case study is Mumbai, because as I wanted to customize it to the local, to bring in a local flavor, I just put it as Hyderabad. And he was the person who used to invest into small caps, and based on his own intuition and certain suggestions from his friends, then even so-called analysts or brokers, whatsoever. So finally, initially, these small caps have rocketed, later totally collapsed. His entire, and finally, when during this particular case study, 80% of his wealth is totally gone. So now, what was there is, later he invested into mutual funds. That is one good investment he made, which gave him consistent returns of 10 to 12%. And while he invested some money into credit risk funds, but through mutual fund, these are the funds which are generally, to be given to risky kind of a businesses, and then they are like, they issue some bonds, corporate bonds from companies, which are, which we tend to view it as, a risky kind of a thing. And say in case of ratings, it may be C or D category ratings, and they offer you better interest rate, but however there is always a risk of default. So these are the companies which have a risk, they defaulted, so the funds were frozen by the mutual fund house. So this money is also totally blocked, and it got evaporated. So his post-retirement dream was to have, world tour. So that also got collapsed, because it's all the wealth, whatever he has invested, it's totally gone. Then finally, what are the assets which is left out is, excluding residences, 3 crore in small cap, for bank FD 2 crores. This is what is left out. So these are the real cases, and in fact, this can happen even with us or with the people whom we know. So how to come out of it is a big thing, big challenge, because there are so many players within the market. The market players are too, they are into it. There are some operators who operate, and there are some analysts and news agencies and so many other mediators who tend to increase something called as, they'll try to resort to increasing greed in you. So they evoke greed in you, and with the greed we tend to change, alter our behavior, otherwise we would not, otherwise would have resorted. So ultimately, because of our greed, we tend to lose that money as well. So those players, they smartly play in such a way that they try to increase a particular stock, they catch hold of a stock, and then they try to jack it up to such an extent that it goes high. Finally, it busts, like Harshad Mehta scam or any other scam. Ketan Parekh, or you take any scandal which has happened in the stock market, they all have a similar kind of a thing. They initially jack up the prices, they ensure that people are lured into it. Finally, our greed takes over, the fear factor. And Warren Buffett said a very good quote, you should always be very careful when the greed takes over, and you should be very fearful. And then when there is fear in the market, you should be greedy. That is the time when you need to enter, invest heavily into the markets. And what are the mistakes we tend to do? The mistakes why these people failed is, They never had any clear investment objective or a plan. So they don't know what to do, what are their plans, what are their goals. They don't analyze what their risk appetite is, what is the fund flow they are expecting, where at what stage, what kind of funds they want, and how do they take care of all their needs, be it children education, be their marriage, may be funding for housing, for the tour and travel, and all those things. We need to have a careful plan and objective, and we have to put it into numbers and time frame. This is very, very important. Then the second mistake we tend to do is we tend to trade too often. Even till very recent, I did the same mistake. I used to, trade so often that ultimately, you are paying more to the stockbroker. And all these analysts, everybody, they will always say about, short term, this much returns you will be getting 15% return, 5%, 20%. So why they want you to go into a short term trading is because the more you trade, the more benefit is for that particular stockbroker, right? So then comes is too much of trading will say, suppose I'll give you certain graphs also I have put in. I think at that time I'll discuss in detail and in depth. And then the second aspect is that lack of diversification. Many a times whenever I discuss with many of my friends, they always say that you take only 5 or 10 stocks, you put into it, otherwise it will be very, very difficult to track those stocks. And in my portfolio I have a list of stocks of more than 220 or 230 stocks. So I have a huge portfolio, and many say, oh no, no, this is the wrong way, but it's okay as long as you are comfortable. And there is a saying, portfolio theory says that if you diversify your portfolio, there is chances that it will take care of the unsystematic risk. Systemic risk, in any case, that will be affecting the entire industry, entire of the people. Whereas when you don't have a diversification, you will have something called as a industry risk or firm specific risk. So in order to avoid that, you need to choose the diversification and diversify into those areas where you tend to, many of the things, they are cyclicals. There are certain industries which are called, defensive, the like, pharma or FMCG, all those things. They will be always there, irrespective of demand supply. The fluctuation will be very, very less because everybody needs them. Medicines, then your food, beverage, all those things, they will be uh, uh, almost constant or will keep on growing with the population. If the pro if the country tend to become more prosperous, naturally the demand for these products also will keep on increasing. Then the third aspect, which is very important, is that we tend to pay high commission and fee for all the transactions we tend to make. Say, suppose you put money into real estate. What is the money amount outgo which you put into it? One is that you have to give that 10 to 15 percentage as a so-called stamp duty, then brokerage fees, and then the commissions which are taken by for funding. Those banks also take some interest rates and all that stuff. Then third of next area where we tend to make risk is we tend to chase short-term returns, not the long-term. In short term, we always tend to think that this entire markets go in a sinusoidal fashion or sine curve. Like there will be troughs, then there will be peaks, and it keeps on going. And if we are very smart, you invest at the trough, and then in the peak you exit. You tend to make a good amount of money. That was even my initial philosophy. But finally, I realized that I made so many mistakes that companies like India Bull Ventures, I initially took it at 22, I sold it at 33. It went to up to 310 or 320. So I missed the entire bull run. So similarly, till very recent also I was committing such kind of mistakes. I give you one example. There are many such examples which I committed a mistake. And for this, there was a very famous, stock analyst or wealth manager, Peter Lynch. He said it is just this strategy is like cutting the flowers and flowering, watering the weeds. Like we tend to sell off the company which is doing very well, whereas what we do is we try to hang on for a company which is loss making. It keeps on going down, we tend to wait, or we tend to add more equity, assuming that it will become more what do you call, more profitable, but that profit will never come. Some companies will totally lose. In my own experience, I have at least 4 or 5 companies like Gitanjali Jewelers, then Pinkon Spirits, then Sunil High Tech, and there are few more. Those companies stop trading at all, and you have that risk. So when you put money into it, your entire money is totally gone. So you need to be very careful choosing the right. You have to choose the right kind of stocks or investments, and then finally you have to stick for a very long term. And then the next aspect is like the timing of the market. What we do is typically there is a lot of market pitch. What they tend to do is by say the stock market channels, maybe CNBC or NDTV Profit, all those companies, they tend to pitch up only when markets are going and they reach the peak, and we tend to see their growth all of a sudden 100%, 200% or 300% growth. We assume that this growth will keep on continuing, and finally put our money and we lose, because that is the area when it goes to peak. That is where we tend to put our money. Later it will crash so badly that our entire wealth is vanished. The moment this happens, you tend to have a very negative feeling about equity. This is what the operators do. Operators try to steal your money. They want to steal your money. They wanted to eliminate you as a competitor. So always remember, you have to go opposite. You have to question, why the hell he is trying to influence me? Why this? Why not that? You have to go through something called as a fundamental analysis. And today I was going through the one book called as the Warren Buffett Way, and I was very surprised. In 1989, Warren Buffett never had a computer, and all his analysis is done very, very crudely with certain principles that we come up at the later stage. But yes, what you need to do is you need to have certain, first thing is called as, you need to have a investment philosophy. You have to have a philosophy, what kind of a strategies you adopt. You should not go blindly by what people are saying, right? And you need to have a very careful understanding about the market, how it performs, who are the players, who are the operators, how do they operate, why do they operate, and whether they are beneficial to you or not. All these kind of a things you need to put it. And always remember, never be in a hurry, either to purchase or to sell. Always market is there since last 200 years. It will keep continuing till even after death also. It will keep continuing. So it will continue. Markets will continue. It will never stop. So never understand. And the pitch, the kind of a pitch these kind of analysts and all those operators, they make is that as if you don't invest today, you lose a golden opportunity. Don't go by it. You always apply mind, take your own study, make your own study. Never go by what others say. You always have your own ideas and views and also philosophy. Accordingly, you build your own strategy. Then comes is we tend to ignore inflation and also taxes. The more we trade, we tend to add more and more of taxation. If it is short term, it is 15% short term capital gains tax. If it is a long term, more than 1 year, it will be 10 percentage. The more transactions you make, the more taxes you have to pay. So you be very careful about it. Hence, don't make too much of purchases or too much of trading in any of the things. Ultimately, you'll end up feeding all those, mediators, brokers, all those people, but you tend to become more poorer. And then, second, and another aspect is you tend to take advices from our friends, relatives, advisors too serious. If somebody says something, we tend to take it and then we blindly follow it, or we have so much of trust in them that we don't even think, we don't do any kind of a study. And then finally we tend to put our money into it, and later we repent our decision. Then, very important thing which I put it at the end, but however, yes, you don't take the noises made by intermediaries, media, and social media too seriously. Never take it. I have enrolled myself into many of these stock kind of a trading, uh, social media kind of a thing. I was just, sometimes I follow through what they are saying. I generally don't take their advices very seriously because I had a very, bad experiences with these kind of people. Like even at one stage, one of my senior, he suggested a person who in the past was a stockbroker in Bombay Stock Exchange. So he used to manage my this one, and ultimately I landed up into losses. And whenever I did my own independent, stock picks, that went on very well. So then I realized this will not work. Only when I am doing my own picks, they are doing well. And then next one is never put too much emphasis on very risky stocks. As the name suggests, they are highly risky. Initially, they may tend to give you a return immediately. They will show it. The problem with the risky stock is they are either in the upper circuit or a lower circuit. When they are in upper circuit, you can't buy, and that is the time when you tend to be very very greedy. So you wait till you keep on. Even it happened with me. I kept on putting money into certain stocks. Finally, I got it like Urja Global. Then there is one Stampede Capital. So finally, what you'll end up is you'll end up paying at a purchasing at a very high price. The moment it falls, you can't even sell it where there are no takers. So your entire wealth collapses. At one stage, I had all these, risky kind of stocks, losses of around 90 to 95 percentage. And between 2007, I invested till late 7 or something like October to January or February of 2008. And later what I did is after marriage I sold my wife's gold and finally put into stocks. Finally, even that was a time when stock market crashed by more than 50 percentage, more so with these so-called small caps. And then I have had to withdraw in 2011. Later in 15, 16, like 16 I started. 16 again the same mistake, like the mid and small caps, again risky kind of a thing. That also landed up in uh, there was a crash immediately after 2017, where SEBI has come up with a guideline stating that mutual fund agencies cannot put money into the so-called mid cap and small cap. So again, mid and small cap collapsed like anything. So that was a very good kind of an experience, because in stocks you need to see the other side of it, and I'll never think that all the time you'll be making money out of it. But yes, after these lessons, I was quite successful in picking the stocks and making money. Now I am more into the long term kind of a thing rather than going for any kind of a short term. So next is like cyber attack losses. These days we tend to use all kind of online transactions. Whereas there was a study conducted by IMF. So according to that, there is always see, if you from the day the incident has happened, if you tend to immediately act, there is a chance that you may not lose much, but the more the delay, the less is likely that you'll land up in losing. So on an average, it was found the median level in which the people lose money is around 25 to 30%. This is what is the losses during cyber attack losses. So you be wary of it, and these are certain mechanisms where smart people tend to take away your money. So be wary of this kind of cyber attack losses. And then what are the perils of Indian high network individual? As we discussed in the past, the high network individual of India, he tend to own mostly real estate or physical assets, 85 percentage, and only 5 percentage is in the form of financial assets, whereas 11 percentage is in the form of gold. If you see the West, it is opposite of it. 85 percentage will be into financial assets, and probably 11 percentage is into the so-called real estate, and 5 percentage or even less than that into gold. So what is important is to monetize each of your asset class. The better you monetize, the more likely that you grow rich. So now there are certain myths surrounding the so-called investing in India. So we always tend to think that gold will protect our wealth, and gold is a kind of a security. It will be very good, right? In the long run, we will be more beneficial, right? However, that's not the case. And there is a study conducted for around 30 years. Annualized gold returns is somewhere around 9.3 percentage. Whereas BSE Sensex, only the market index itself is giving you 14.8 percentage, which is 5.5 percentage more than gold. So if you see the decadal position between 1990 to 2000, gold has increased hardly 2.8 percentage, and then the stocks Sensex in that particular period it grew by 14.4 percentage. Then when it comes to 2000 to 2010, the 10-year decade, the decade of 2000 to 2010, it's around gold yielded somewhere around 16.3 percentage, whereas BSE Sensex is 19.9. Even at that time, also BSE Sensex have beaten the gold. And even the third what do you call third decade, 2010 to 2020, even in that decade also the same story, 9.2 percentage decadal growth in case of gold. In case of BSE Sensex, it is 10.4 percentage. And if you see the cumulative periods, 1990 to 2000 to 2020, gold has given a return of 12.7 percentage, whereas uh, this BSE Sensex gave 15 percentage. And if you see, the standard deviation is basically the risk. Okay, how much risk each have. When it comes to gold, gold has uh, over a 30-year period, gold has relatively less risk compared to Sensex, but returns are also on a lower side. So another set of people, they always suggest that yeah, their gold and equities are negatively correlated. So whenever the stock markets don't do well, you have to invest into growth. But the study conducted by this Saurabh Mukherjee and his firm, it was found that There is no such correlation except in the period 2010 to 2020. There was no such correlation, especially in the period 1990 to 2020. Both grew in tandem. So understand that there is no correlation, or you can say a negative correlation between gold and equities. So that is also busted. Next, could you see this? Okay. Next myth is, we all tend to do. We always think that real estate is the area where you get a lot of wealth. That is also totally wrong. It is totally a mistake on the part of us to assume that real estate gives you wealth. This is a global study. In fact, it is. You can get it from website also. I'll tell you in the later state. In the later slide, you will get that detail. So in this particular real estate, you just see the second one. India, there is only a study conducted in case of Mumbai only. In Mumbai, the rental yields are 4.54 percentage. Rental yield is nothing but how much you invest and how much annual yield you get out of it. So 4.5 percentage means it takes around 22 years to recover the money from for the investment you made towards a particular house or any property. So this is a case study of Mumbai, but whereas when it comes to other cities, it may be even much lesser. Yields may be much lesser. And then what is the actual cost when you tend to buy or sell? You have to pay 11.88 percentage. As I said in the past, stamp duty, all that stuff. So next is rental income tax. Income tax you have to pay around 5.82 percentage as a tax. Then there is another thing which is called as capital gains tax. Every property you sell, you have to pay 30% capital gains tax, or again you have to invest the same or similar amount into a similar asset, real estate. So price to rent ratio is, it takes 23 years in case of Mumbai to get back the amount invested in that particular property. Whereas in India, the landlord rights over that particular property is pro tenant. Tenant, if he stays for beyond a particular period, he have a right to own that particular thing, irrespective whether it is right or wrong. Then house prices increase in last 5 years is only 15.5 percentage, whereas GDP growth in last 5 years is 31.76 percentage. That means it is not catching up with GDP growth. So its growth is much lesser than half of GDP growth. And then investment ratings. Rating 5 is the best, 1 is the worst. So investment rating is 2. So you can make your own choice whether to go for real estate or not. Then there is this, I gave one, what do you call, a link in which they have given somewhere around 20 or 22 Indian cities where they track the prices of each city, and then they give you the trends. So that gives you some kind of an idea like what is the yield you will be getting in case if you invest into real estate. So as I said in the past, purchasing real estate will be the most expensive thing, right? And then your entire lifelong savings are put into it, and then there are so many taxes you need to pay both to state government, and in case if you are selling, then you have to pay capital gains tax at the rate of 32%, 30 percentage. Then other taxes around 5 percentage, that municipal taxes, all your house property tax, all that. Then finally you land up nowhere. And That is the reason why this particular slide, if you see, if you go through it, you have seen it's a number of months of rent, and that it is just simply like how many months of rent you need to get to own that particular house. So cities like the best is Vadodara. It takes 298 months. 298 months is nothing but around 25 years. That is the lowest. And when it comes to the highest one, it is Vishakhapatnam, which is 606 months, 50 and a half years. So there is no point. Do you need to own a house and then recovery of it will take so many years? And for you, you just need one house, or even if not one, even the better one is like if you can rent a better house, then you can pay for a very cheap price. At the same time, you can keep changing the houses and enjoy. So this is one more philosophy. Instead of putting so much of money and wealth into the house, you can shift it to other assets. So now the third myth is we all tend to have that debt mutual fund offers you a very decent returns with low volatility, except for AAA rating bonds. The rest of them are, AAA rating bonds are again, they are also having, their yield is also similar to the risk-free bank interest rate. And the riskier the corporate bonds, the riskier is the asset. So there is a risk of default, as I gave in the case study which you have read it. Just you have seen it in the past, like in case of Mr. B. So now mutual fund debt returns are just above or at the same level as bank interest rates. So debt mutual fund too is not a very interesting option. Next, some people say, GDP growth, based on the GDP growth figures, I would like to, invest. When the GDP growth rate is high, I will put money into it. When it is low, I will withdraw. No, that is also, there is no correlation between GDP growth and markets. If you see exactly that coffee color patches, light biscuit color or coffee color patches, they are all when the market behaved opposite of the hypothesis, like GDP growth and your stock market performance is directly correlated. It's not so. So, so that is also busted. So never think that once I'll only invest when I get to know what is the GDP growth rate. No. See, for example, during COVID, that was a period when initially markets fell down, but later it has recovered despite negative growth. So there is no correlation between it, and you market is always there. Any time is an opportunity. So now comes is what will multiply your wealth. So any answers? Obviously equities. It is equities. Equities tend to give 13 percentage compounded annual interest based on the research conducted in last 80 years when it comes to Indian stock markets. So or else it doubles every 5.3 years. So in 22 years they multiply by 60. Anyway, sorry for that interruption. Anyway, so ultimately it is uh, the equities which will give you a kind of returns which will be 13 percentage, which is quite decent. Right now the bank will offer you an interest of around 7 or 7.2 percentage. So this is definitely more higher than that. So even if you assume FD at 7% interest rate, it roughly grows 4 times during the same period. and that is something called as the power of compounding. So this is a very wonderful quote which is given by Peter Lynch, which I refer to in the just in the past. Know what you own, know what you own it, why you own it. Like when you are owning a particular asset class, you should know what is that you are owning it, and also why you are owning it. Many a times we tend to, take advices from some XYZ, and then without doing any actual research and proper study, we tend to fix it and finally put our money, assuming that they may give better returns. But generally, it may not happen that way. It may be, unless you know what you own and why you own, you won't, it may be something than what you expect. And then this is a very interesting graph, if you can see it. See, this gives you like tectonic shift between the countries, nations, how they are going to grow. These are projections. The last three columns are projections. But however, despite all that, yes, India is going to grow. Why I put this particular graph is to emphasize that India is a country which is going to grow very big, quite good. So yeah, increase the size. I'll just check it. Is this okay?
Yes, yes.
Is this fine? So I think the rest of the countries are not that important. What I wanted is, see, US is going to be assumed to be relegated to the position number 2 by 2036, whereas India is going to grow to the third position from current positions. So India as of now is somewhere around $4 trillion economy. In another say 12 years to come, it is going to grow by 2.5 times. So 2.5 times it is going to grow up. So that is the potential which it had. Since it is going to grow, it will have impact in when it comes to the even our assets. If we tend to take equities, so that will also grow with the growth in Indian economy. So this is an interesting area, a graph which I thought you all should know what it is. This is a usual, you know, growth curve or sinusoidal or sine curve of economic growth. And nobody for sure knows what is the exact percentage growth. All are projections. Projections are always, estimates. They are not real. Reality may be something. Nobody can, predict it. But yes, yeah. There are certain phases in the economy. There is a stage where it starts from recession, when the capacity of the industry has far exceeded the demand. That is where the companies stop producing any goods or services. So when they stop producing goods or services, naturally because there is lack of demand, they will try to curtail all the expenditure, including on wages, salaries, and employment. So ultimately, during this stage, you find many people losing jobs or their salaries getting shrink. So that will continue till a stage till a stage called as a slump. Slump is a stage when the companies have liquidated all their surpluses, whatever surplus stock is there, and from there they don't have enough stock or the produce to meet the demands. Since there is less stock with them, the so-called maybe the goods and services, they tend to hire more people, spend more towards raw materials, spend more towards other things like logistics, marketing, advertising, all that stuff. There is an increase in growth. That is called as a recovery phase. That recovery phase will continue till the peak, which is called a growth. That is the peak. During peak, because nobody knows exactly what is the demand and how much they have to supply, they keep on fluctuating demand and supply. And then during that growth phase, they supply so much in abundance that there will be a lot of inventory of both services and goods and services. So that is the time when they understand that the growths are not matching with the supply they have. There is an oversupply. So what they do is they tend to reduce one the expenses on the working capital, especially towards material inventory, or or the labor. All these things gets reduced, so that will lead to recession and slump. Again there will be a growth. This will continue. If you understand the economic life cycles, you would be in a better position to understand how the economy behaves. And then this cycle, economic cycles, usually around 10 years. Why 10 years? Because that is what is the life of consumer durables, right? 10 to 15 years. That is where, and the entire life cycle is dependent on the demand and supply cycles of these consumer durables. It can be car, it can be a fridge, it can be television, it can be a laptop, it can be anything. Then this is another interesting, of course, these all, slides are all basically what you get in WhatsApp. I didn't produce anything, but yeah, whatever I felt it to be interesting, I put into this. So you see, this is a graph which gives you where the stock investors are. So if you see overall, 20 percentage of investors into equities are in the state of Maharashtra, followed by Gujarat, 10 percentage of Indian population, Indian stock investors. Then the third position is of UP, 9 percentage. Then comes is Karnataka, 6 percentage. Then Madhya Pradesh 5 percentage, Tamil Nadu 5 percentage, Andhra Pradesh 4 percentage, Telangana 3, so on. Right? So one thing you easily find, the bias is towards the west. Even the Rajasthan is also 6 percentage. If you see the states adjacent to Bombay, they are the places where, or the states where they invest into stocks. And of course this is only in terms of people who own stocks. But if you see in terms of percentage, state wise, it may be highly skewed. It may be Maharashtra, Gujarat in any case, and Rajasthan. They may be controlling, or rather they may invest around 50 to 60 or even more percentage of the entire Indian investments. So this is again an interesting slide which gives you an indication about the population of India is 144 crores, whereas people who invest into stock markets are just 8 crores, and mutual fund investors are just 3.5 crores. That means there is a huge scope for increase. And with time to come, especially the young kids are highly tech savvy, and they are the ones who are entering in large numbers, and they love stock trading. Why I'm saying you need to invest is, yes, these are the factors where you will get advantage. You can take advantage. See here, this is another interesting uh, what do you call a slide. You see, when it comes to investing into stock market, the highest is in any case USA. 48% of their population invest into it. Whereas when it comes to India, it's only 3%. While other countries, if you see, usually the English speaking countries will be heavily invested into stock markets for a simple reason that those countries finances are based on markets, not on banking system. Whereas countries like India, China, sorry, not China, Japan, Germany, they are all heavily dependent on funding by the banks, not by the investors. Equity, equity is very less. So that is a skewed kind of a thing, depending on their own past experiences, then their understanding about markets. So this is one interesting slide which I thought you have to, it gives is a kind of an understanding like which segment in the finances where India borrows. That matters a lot, though it is of 2022, but yes, more or less the percentages may be the same. 50 percentage of Indian public invest into something called the funding goes towards housing loans. So we invest or into houses, so we tend to take huge amount of loans, right? And then 26 percentage towards personal loans, 12 percentage towards vehicle loans. Credit card debt is around 4.75 percentage. Then loans against fixed deposit is 2.61 percentage. Education loans is around 2.4 percentage. Gold loans 2.22 percentage. Consumer durables 0.92, and loans against shares and bonds are 0.18 percentage. This will give you how India borrows. India means it's the individual customers, not the corporate borrowings. We are talking only about the retail borrowings or retail borrowers. So this is a nutshell for today. I think with this slide we can close it. Tomorrow we'll start with risk and return, kinds of risk. That will be another interesting area. Why, what is risk, what is return, how you get into it, and so on. Next is a little concept rich, and then that is very much essential for anyone who is entering into equity. Without this understanding, I think it would be very difficult. As we have said, it's already 10:16, so let us close it for now, and then I request people to ask doubts, queries. Vikas, Anup, Anup, Vikas,
No, no questions.
no questions. ये कैसा हो सकता है? Can it be like you don't have any questions, doubts? Hmm?
Hello.
Yeah, Anup.
Yeah, actually, I just wanted to know about one slide, particularly when you showed that the returns in the stock will generate 13%. And
Yes,
for a
that
long
is Sensex.
period,
Sensex. Sensex.
don't you
Sensex.
think it will
That
be
is.
difficult to generate that kind of return for a fairly long period?
See, I told you this is what is the study conducted for last 80 years. What you said is yes, it will. See, even in countries like matured markets like US, the amount of returns generated by corporates are almost the same, despite the economic growth being 2 or 3 percentage in those countries. So this is something already proven.
Okay. So we need to understand ki when to switch over to which stocks, when to come out from those certain stocks, because you know
Yeah,
ki that is a
that
very
is
important thing. if we want to have a consistent return, then we have to track these things on almost fairly regular basis.
Nay, that is what as I said, you have to spend most of the time on selecting the right kind of a stock.
Yes.
Every stock
What
is
is
not
right kind and how to select that? These are the most difficult questions for a
exactly.
matlab, common investor, I can say. But
Yeah.
people like you, sir, definitely it will be easy, and we hope for good insight on this.
Nay, that will be covered in the later stages. Because now we are going into the players, the operations, how do the markets behave, how do the stocks behave. If you don't understand this basic
Yes,
concepts,
yes, yes,
you
yes,
cannot
yes,
pick up the right kind of a stock. If I say directly start with usually as many people do, if I go that way, you will never
yes, yes, yes.
understand anything. You know, you may land up into trouble at the later stage.
Yeah, very true, very true. Because true dynamics of the markets needs to be understood properly. Only then we can take informed decisions.
Absolutely. Any other question? Acha, when it
No,
comes to
this is all
Anup,
from my side. Huh. Yeah, yeah.
I'll support what you have asked just now. Whether India will be a growth story. That is the reason why I have shown you what are the reasons why Indian growth will continue. First reason is that Indian economy is growing at a faster pace. Second is the market penetration of stocks or the amount of wealth we are putting into stock is less. See, how will a stock market grow? It's a simple demand and supply. The more money chasing a particular stock, it will grow because you are willing to pay that price. So when will it happen? See, that is what is happening right now, in the stock markets. Number one is like all the segment, all the asset classes, be it real estate, FD, or the so-called gold or any other classes, the kind of growth which at one stage it had shown that is not found anywhere now. So you have no other option other than putting money into it, and this is most liquid. See, if you sell a stock within 2 days, you will get the money back into your account, and you can easily purchase it within 2 days. You will get that the so-called share into your account. So this is the safest bet compared to any other thing. See the kind of amount of time for transaction. Say a real estate deal, you just say you have decided to purchase it today. Till the time you get that particular house, you just see how much time it takes, or even a plot of land that
Yes.
has a much bigger gestation
Ye-
period, and it has a lot of risks. In between there are so many risks, and there is no guarantee that the kind of a growth which we have seen in 1990s to early 2000s, the same will be found in future to come. It is already exhausted.
Yes.
Small cities, small towns in India, if you want to purchase the entire real estate of it, and entire money or wealth in the entire nation has to be put into it. Your entire GDP should be, put to purchase that real estate for a small town. Understand? See, that is the money it will
Right,
be
right.
sunk into, and those are all once you put into it, it is a dead capital. And then
Yeah, it
second,
is a debt trap, and most of the time we feel ki appreciation, capital appreciation will be like anything, which is isn't true every time.
no, not at all true any further. At one stage, it was true in 1990 to 2000. During the early phases of globalization, there were some other factors, not just economic boom and all. See, during early stages, there was once the economy got started up, the MNC started coming into India. They started investing. After investment, they started paying heavy salaries, be it software or MNCs. So those people with huge money, pocket. So what they did is because they are willing to pay any price. The real estate market has boomed like anything. And then there was another stage when 2011, 2001, when that Twin Towers were blasted. There was a lot of harassment to global Indians, NRIs and all those people. Then they were feeling very shaky and panicky, like whether they will be allowed to continue living. And many of the people, if you discuss that in those days, they were always saying that we would like to come back to India. It is not safe anymore in this country. So that kind of a views you tend to find it, and that was coincided even after 2001. This Twin Tower blast. There were many bomb blasts in London, Paris, all those places where global Indians are. So those people, they put their life savings in those countries to India, and then they started paying huge money. That is now no more. Let's understand.
Right. Yeah. Yeah.
So that is, then the other aspect is the kids, the future upcoming kids, they're all tech savvies, and they are more willing to take risks. So they wanted to do the stock trading. So the trading will increase. So the money inflows into it will increase. Then the other part is like, there was, I think, if you remember, there was one stage when there was a kind of a rumors, or rather it is, you can say that it's deliberate rumors stating that, or rather it is a fact also, that your money inside in bank accounts is not very safe. Only 1%, 1 lakh will be, you know insured, and then rest of the wealth will be vanished if the bank goes bankrupt. So at one stage there was so much of issue related to this PSU bank, NPS. So everybody were thinking that yes, we are on a shaky wicket and better to put our money into stocks. So even I am one of the person who has shifted my bank balances into stocks. So many, yeah, I think this is one of the reason. Then recently, if you remember, pension and PF funds are also allowed to enter into markets. So this
Yes.
will
Yes. Yes.
contribute. This will contribute in any case. Apart from this, there is foreign institutional investors who will contribute more towards, equities. And then other thing is, like, these days mutual fund and SIPs became much more, uh, what do you call, more ubiquitous, or they are becoming much more popular, and their share and pie is also increasing. So again, there is a SEBI guidelines that you cannot hold cash for very long. These mutual fund houses, they have to invest. They cannot hold cash. So that will churn the markets, right? No, I think
Yes.
you
Yes.
got the
Yes.
answer.
Yes. Yes. But per se, just investing in the stock market can whether that amount will go in real investment, which will grow in future. That has to be seen.
That is why, see, there is an analysis done by Sanjay Mukherjee in Saurabh Mukherjee. He did it very excellent work. There are three kind of categories of stocks. One, 80 to 90 percentage of Indian stock, 85 to 90 percentage ratio में. Such kind of, stocks, they never grow. They don't generate enough ROCE to compensate for cost of capital. So they land up into debts. Finally, they either collapse or totally gone, bankrupt. So what we need to
So,
do, another 10 percentage of stocks are there. They are of blue chip companies. They grow, if not exceptionally well, yes, around 10 to 15 percentage, because they are almost nearing to, they could recoup their cost of capital, and they are a little profitable. So that profits churn it, and they keep on expanding, and they grow, and then they deliver, they give you returns, decent returns. So these are 10 percentage stocks. Then there are minuscule percentage, maybe 0.1 or so, those are the stocks. They are going to grow very at say 20% compounded growth rate. So what those stocks are, that is where your intelligence, that is where your analysis, that is where we will discuss all those things, how to identify such kind of stocks. And
Yes, yes.
that needs better understanding about the strategies. Those companies, they generate something called as sustained competitive advantage, right? When a company has a sustained competitive advantage, they create something called as economic moats. Economic moats will give them more wealth. They tend to give consistently good rate of returns, better than others, and they can penetrate more into the markets. Say tech giants like the so-called Microsoft or your Nvidia, all these companies, they give you very decent returns. They are far ahead of their competitors. So that's where your entire intelligence and your thing lies in identifying those stocks. That is why I'm saying you have to be wary of these so-called the scoots or operators. You have to come out of uh, operator driven decision making to your own fundamental analysis and your own analysis, right?
Right.
Anybody else?
Suresh, you were saying that long term and short term. How can we identify long term 3 years or 4 years or short term six
Long term is
months?
basically, in the stock parlance, long term is 1 year,
Yeah, okay,
right? Anything above 1 year is long term.
fine. Thank you.
Anything less than 1 year is short term.
Okay, okay. We'll wind it off and let 3 are there.
Yeah, yeah. Anybody wants to ask any question, they are free, or else we can wind it up.